Welcome to the class of Financial Accounting 2. I'm Mr. Ezra and I'm going to train you Financial Accounting 2. So Financial Accounting 2, we are going to do the same definition that we did in Financial Accounting 1. So it's going to be a little bit of an advancement from Financial Accounting 1. So what is Financial Accounting? You want to know what is Financial Accounting? So you have the course outline. We are going to discuss all of those topics that you are going to see in that kind of particular platform. So financial accounting is basically the process of recording business transactions and summarizing them into financial statements for decision making of the users. So it's the process of recording business transactions and summarizing them into financial statements for decision making of the users. I want us to underline the business transactions, and then we are going to underline the financial statements, and also we are going to underline the users. So let us start from the business transactions. So it's the process of recording business transactions. So what are the business transactions? So business transactions, we have two types of business transactions. We have the cash transaction and also we have the credit transaction. So cash transaction is when you purchase goods in cash basis, and the credit transaction is when you defer the payment. You are going to pay in a later date. So those are the two business transactions that we are going to record in the books of account: the cash transactions and also the credit transactions. And then we go ahead and say I'm summarizing them into financial statements. So what are these kind of financial statements? So from our Financial Accounting 1, you learned that we have three main financial statements. The first two are prepared in accordance with International Accounting Standard number 1, and the first one is the income. So financial statements, we have the income statement, and then number 2 we have the statement of financial position. Statement of financial position, and then number 3 we have the cash flow statement. So these are the basic financial statements that you need to know. The income statement, which is going to show us the performance of the business in terms of the profits that it has generated in a particular financial year. And then the statement of financial position. So the statement of financial position is the balance sheet. So the balance sheet is going to show us the position of the company in terms of the finances. How liquid is the company? How strong is the company in terms of the assets? How can the current assets be used to finance the current liabilities? So this kind of statement of financial position is going to show us the liquidity of the company on how it has utilized the working capital in terms of actually generating resources. So this is the balance sheet. And then the first two I've said, the income statement and the statement of financial position, we usually prepare them in accordance with International Accounting Standard number 1. Remember, accounting is going to be guided, we are going to be guided by standards. So International Accounting Standard number 1 is the one that talks about the preparation. How can we prepare the balance sheet? How can we be able to prepare the income statement? And how do we prepare the cash flow statement? But now, the cash flow statement has a different kind of standard. The cash flow statement is usually prepared in accordance with International Accounting Standard number 7. So the International Accounting Standard number 7 is trying to give us 2 formats of preparing the cash flow statement. We are going to prepare using the direct method, and also we are going to prepare it using indirect method. So these are the financial statements that we have said here. Remember, we are defining accounting, and we have said that it's the process of recording business transactions, and we have said we have 2 types of business transaction, which is the cash transaction and also the credit transactions, and summarizing them into financial statements. So we are going to summarize these business transactions into financial statement, into the income statement, into the statement of financial position, into the cash flow statement. And then it goes ahead and says, for decision making of the users. So I told you to underline the word users. So these kind of users, we are going to know who are the users of these financial statements that we have actually prepared and summarized. Who are the users? The first user from Financial Accounting 1, you said, was the management. So users here, we have the management. So management is the first user of financial accounting, and the management is going to be interested with the financial statement so that they can be able to know how can they be able to plan. So the management is going to be interested with the planning. How can they be able to plan in terms of preparing the budgets, so they can be able to check the income statement. The profit they get there, they can use it in terms of planning and also in terms of preparing the budget for other kind of key decision making. So management is one of the users of financial accounting information. And then the next user is the employees. Employees are also one of the users of financial accounting information or financial accounting statements, so that they can be able to know the stability of the company. So the employees, they are interested with the financial accounting information in order to know the stability of the company. If the company is very stable, is generating a lot of profits, it has a very strong balance sheet, at the end of the day, the employees, they are trying to advocate for increment in salaries and other kind of bonuses. And if the company is not making maybe enough profits, then employees will start looking for other kind of alternatives. So that's why they are going to be interested with this kind of financial information. So the first two, which is the management and the employees, are the internal users of financial accounting information. Management is the internal user, and the employees is also an internal user. Let us discuss other kind of external users of financial accounting information. So another kind of user who is now going to be an external user, we are going to have the competitors. Competitors are the users of financial accounting information, and the competitors are going to be interested with financial accounting information so that they can make strategies. So the key main need for financial accounting information by the competitors is for strategic purposes. They want to make strategic decisions so that they can outwit, or so that they can judiciously be able to come up with the strategies to win the competitor, to outdo the competitor, to make sure that they are selling more than the competitor. So the key thing that the competitors are going to be interested is for the strategic purposes. They want to make strategic decisions to be ahead of the competitor. So this is an external use of financial accounting information. And then another kind of user is the government. government, the government. So the government is going to be interested with the financial accounting information, and it is going to have two purposes for this kind of financial accounting information. The first one is that they are going to be interested with the tax. You know, the government wants to tax you from the income that you have generated. The income statement is going to show us the income that you have actually generated, so that they can tax you according to the income that you have generated. So that's the first need of financial accounting information by the government. They want to know the revenue you have generated, and then they tax you accordingly. Remember, if you have a company like in Kenya, if you have done taxation, because you are taking accountants, remember the residence companies, they are supposed to pay a tax of 30% from your knowledge of taxation, and then the non-resident companies are supposed to pay a tax of 37.5%. 30% of the revenue that you have actually generated, the gross revenue, and then the 7.5% of also the gross revenue that you have generated in a particular year. So that's what the first reason the government is trying to be interested with the financial accounting information for tax purposes. The second reason is actually to be able to know is the business that you are operating legalized. You know, they cannot be able to advance your license if you are operating maybe an illegal business. Like in Kenya, you are not allowed to sell cannabis sativa, that is weed. You are not allowed, they cannot give you a license. So the government is going to be interested in financial accounting information for regulation purposes, so that they can be able to know the businesses that they have registered are legal businesses. They are not businesses that are not allowed under the laws of Kenya. So that is the second use of the government tax, and also the legality of the business. So another kind of user of financial accounting information is the investors. So investors are going to be interested with the financial accounting information, and we are going to have two types of investors. The first investor is the potential investors. Let us first start with the present investors, and then we go to the potential investors. So we are going to have the present investors, and then we are also going to have the potential investors. So you have the present investors and the potential investors. The present investors are going to be interested in the financial accounting information so that they can actually be able to know if the company is generating a lot of revenue in terms of profitability. They are going to add more investment, they are going to increase the investment. And if the company maybe is at a break-even point, it's not generating a lot of revenue, maybe it's not actually making losses, it is at a break-even point whereby total revenue is equal to total cost. At the end of the day, they are going to maintain that kind of investment that they have in the particular company. And if the company is making losses year in, year out, then the present investors, they are going to make a decision of actually decreasing their investment or selling the investment at the end of the day. So that's why they are going to be interested with the financial accounting information, because present investors are the investors who have already invested in that kind of particular company. And then potential investors are the investors who will like to invest in a particular company. So the potential investors are going to be interested with the financial accounting information, or financial statements, so that they can be able to know the risk inherent in that kind of particular company. So the risk inherent is that kind of particular risk that cannot be avoided, maybe due to the complexity or the nature of the business. The risk cannot be avoided. Maybe the business is so complex that at the end of the day, some employees can be able to go with the steel, some commodities, assume that it's a supermarket. So there are some risks that you cannot be able to avoid. So the potential investor is going to assess the risk inherent and then be able, if the risk inherent is manageable, then the potential investor can be able to invest in it. But now, if the risk inherent there is such that the potential, like now, let us talk about mismanagement as a risk inherent. If we are going to have mismanagement, it means that we have maybe incompetent managers who are managing that kind of particular concern. So if that is the risk inherent, then it is going to send shockwaves to the potential investor. The potential investor cannot be able to invest in that kind of particular company because the risk inherent is not manageable enough. There's no way you can invest in a company whereby the CEO of the company is a class 2 dropout. At the end of the day, your investment is going to nosedive. So that is what the potential investor is going to be interested in, that kind of financial accounting information. So another kind of user of financial accounting information that you learned was the lenders. So lenders are the providers of funds. These are the people who are going to assist us with some funds. They are going to advance us some loans so that we can add up to our own equity, and then we invest in a particular kind of venture. So lenders, before they give you the loan, that kind of loan, they are going to check, especially the statement of financial position is the one that they usually check. They are going to check if the current ratio, we are going to discuss later on the current ratio. The recommended standard of the current ratio is supposed to be 2:1. And the current ratio is usually given by current assets divided by current liabilities. When you are trying to do ratio analysis, this is how you calculate the current ratio. Current assets divided by the current liabilities. The recommended standards in the accounting standards is supposed to be 2:1. The current assets should be double the current liabilities, because current assets are the ones that finances the current liabilities. So current assets are the ones that usually finance the current liabilities. So the moment the company is not going to have the current ratio of 2:1, maybe it has 1:2, it means that it has one asset to two liabilities, meaning that it is not able to pay its obligations as and when they fall due. That kind of company is facing insolvency. So the moment the current ratio is 2:1, then they will give you a loan. And if it is going to be maybe 3:1, maybe it will be more. If the company is liquid enough, they will also give you a loan. But the assets should always be more than the current assets should always be more than the current liabilities. So the lenders are going to be interested with this kind of financial accounting information, so that they can be able to know that are you able to pay the loan amount, the principal amount that you have borrowed plus the interest, according to the stipulated period that you agreed. So that they can make that kind of particular decision. So that those are some of the parties that are going to be the users of financial accounting information. Sometimes in other kind of books, we are going to have the public or the society. The society is going to be interested with the financial accounting information of the company. If the company is generating a lot of profit, then the society is going to demand more corporate social responsibility. Corporate social responsibility is giving back to the society. So if the company that is in a particular kind of society is making a lot of money, then the society will like to see more corporate social responsibility. Like now, Equity Bank. Equity Bank, the corporate social responsibility that it usually provides the Wings to Fly. The Wings to Fly scholarship. Those people are very bright and needy. They are going to be given the Wings to Fly scholarship, and that's what we call the corporate social responsibility. So the public will be interested in the financial accounting information to check if they will advocate for more corporate social responsibility. So that is a little bit of the introduction. I'm giving you an introduction. Later on, we are going to go into details on what we call the conceptual framework, so that you can be able to know if you are being guided by a particular kind of framework, what is the importance of that kind of the conceptual framework of accounting. And then we will also be able to discuss the accounting policies later on, and also the conventions. So for now, we stop there. Thank you.